Hi everyone! Over the past 13 to 14 weeks, we've explored how physiology shapes our individual financial decision, from shortcuts like heuristics to deeper biases like lust aversion, overconfidence, and even how emotions influence our money behavior. Today, we zoom out. What happens when millions of people, each with these same physiological traits, interact in the stock market? What does this mean for the overall movement of prices, bubbles, and crashes? Behavioral finance gives us the answer. It helps explain not just our personal financial mistakes, but also why entire financial market can go irrational. As Beveridge and Teller put it, some financial phenomena can be better understood using models in which some agents are not fully rational. Traditional finance assumes that investors are perfectly rational. They respond to new information correctly, calculated risks and rewards like machines, and help keep the market efficient. But in reality, investors are human. They get overconfident, they panic, they follow the crowd, and these human traits influence how prices behave. Behavioral finance emerged because researchers found too many patterns in the market that traditional theory couldn't explain. Fama, a champion of efficient market, admits most long-term anomalies tend to disappear with reasonable changes in technique. Yet, the fact that we see anomalies at all means that there's more going on beneath the surface. To understand how behavioral finance explains market, we start with two key ideas. First, limits to arbitrage. In theory, if prices are wrong, smart investors should fix them by buying low and selling high. But in the real world, fixing mispricing is risky and costly. Investor may lose money before the price corrects or faces institutional constraint. The second one is the investor psychology. Real investors are subject to biases, overconfidence, fear, herding, then vanish in a big market. They accumulate and shape collective market behavior. Barbers and Taylor explain, even if noise traders push prices away from fundamental value, rational traders may be limited by risk, cost, and agency problem. Sometimes we see patterns in stock market that shouldn't exist if market were fully efficient. These are called anomalies. For example, IPOs often underperform after the hype fades. Stocks with strong recent returns keep rising for a few months. It is called momentum, but eventually many reverse in the long term. Behavioral finance explains this as a result of overreaction or underreaction to news. FOMO notes, apparent underreaction is about as frequent as overreaction. Change generates deviation in both directions. But if these patterns keep showing up, they likely reflect human behavior. Let's look closer at how real people behave when investing. Overconfidence leads to excessive trading. Disposition effect means people hold onto losing stocks but sell winning ones too quickly. Naive diversification causes people to split money evenly without understanding the asset. And herding, investors buy or sell just because others are doing it. These patterns shape the way markets move. They aren't just personal habits. They form the rhythm of market cycles. Barbaros and Taylor remind us that excessive trading, insufficient diversification, and disposition effect reflects predictable investor behavior. Bubbles and crashes when the crowd gets carried away. Markets don't just misprice assets, they sometimes go way beyond. A bubble happens when prices rise far above actual value, often driven by excitement and hype. Think of the dot-com boom and the house market before 2008. Robert Schiller explained how bubbles form. Rising prices from media coverage. The media coverage creates excitement. The investor jumps in for fear of missing out. And eventually, reality crashes the party. Schiller stated that the stock market displayed the classic feature of a speculative bubble. Temporarily high prices are sustained largely by enthusiasm. But not everyone agrees with behavioral explanation. Fama argues that many anomalies are simply artifacts of bad model or weak data. He stated that behavioral models work well on the anomalies they are designed to explain, but others remain embarrassing. Still, behavioral finance doesn't claim perfection. It simply accepts that investors are human and that this humanness show up in prices. Behavioral finance isn't just a theory, it shows up in the real market episodes. For example, during the dot-com mania, investors poured money into internet stocks with no profit because they didn't want to miss out. With IPOs, the public get excited, pushing the prices too high at launch. More recently, meme stocks like GameStop exploded in price, not because of fundamental, but because the online hype and group identity. Shillers capture it well. Herd behavior and media contagion can amplify mispricing far beyond fundamental. But why did it matter to you and to us? If you and me are an investor, analyst, or a policymaker, behavioral finance can help you see the bigger picture. Are you reacting to real information or just emotion? Are others acting rationally or following the crowd? Can you recognize when markets are being driven by sentiment and not value? Behavioral finance helps us make better decisions, not just with money, but with how we think about financial system. Philip Fisher once said, "The stock market is filled with individuals who know the price of everything, but the value of nothing." And Robert Schiller reminds us, we need to know if the price level of the stock market is a sensible reflection of economic reality. Behavioral finance teaches us to bridge that gap, to see past the numbers and into the human stories behind them. Thank you.